What's up, Outliers? Happy Friday. Today's stream is about all three, but we'll talk about more of three of my largest trading habits, bad habits. And I want to specifically talk about how I overcame three specific trading habits that I know, at least for me, they were some of the more nefarious ones that have, without a doubt, a bottom line P&L impact. Now, we just started on the pro live stream on Thursday. We started reading a book from you and Sinclair together. It's actually kind of fun. It's like a really nerdy version of like a book club. But the interesting thing in there is it has led to a lot of introspection. That's one of the reasons why I like to read, especially about trading. As I mentioned in the stream yesterday, it's not really frequent where I'm reading something about trading and I'm coming across like droves of just brand new information. Over time, that starts to go away. But nonetheless, even things that I might be pretty comfortable with, competent with, knowing of, it still always gives me a great exercise in revisiting things and revisiting super important concepts. So that's literally what spurred the topic for today. I'm not actually sure when I'm going to do the next formal end-to-end options trading series. My hope is maybe to start it in a couple weeks and literally to work through it. You work through from the basics of introducing what options are all the way through. But in the meantime, there are a lot of skills and gaps that I want to fill, especially for those that are a little bit more seasoned, which I imagine is actually the most of the community. I don't think there's going to be a lot of people hovering around the community that are brand new to options. You kind of have to go learn a little bit, and then this place becomes a better fit. I consider our community to be a good fit for like intermediate on, late beginner, early intermediate, because I definitely make enough attempts to connect those dots for people, but it's definitely not for brand new beginners. So the question of the day in the chat, hey, what's up, Lauren, Mark, H? H's guess is let losers ride and take winners off early. It's a good guess. We'll see if that one comes up. He's responding to the question that I asked in the chat, and I actually am really, really curious what you guys think my self-evaluation is. So the question I have in the chat is, I want you to take a guess at one or multiple of the habits that I'm going to refer to today and walk through with us. So let's talk about just the broad thing of trading. And then what we're going to talk about today is going to span two different levels. There will kind of be a bit of a generality, and then there will be some option specific stuff. So it's not really going to be three. It's going to be three broader levels, but then I have some ideas on what I want to talk about in the subtext. Dark Mark says too risk averse. It's a great guess. That absolutely shows that you know a little bit about me, because that is one of them, actually. Good guess. So let's overview what trading is. We know it's really our attempt to interface with the marketplace and produce a profit in different ways. The way that most of us start this thing called trading is from a completely different lens. So when I think about my start in trading, this is the start, right? I got into markets, I got into investing because of this dude, and I knew nothing about any of this stuff. I did not grow up in an area where this stuff is like common knowledge or shit that people that I know talk about. I grew up in a very different landscape where you can kind of just see some of these general articles The stuff with like school shootings, unfortunately, well, I guess fortunately, unfortunately, it has become more regular. Thankfully, that wasn't as much of a thing that I experienced. But knife play was very common, getting jumped, and those kinds of things. So it's not to paint some sort of sob story. It's literally just to provide some context on the starting point, because my guess is my starting point is not that different from most of you in different ways. That's my guess. My guess is if we look at the way most of us get into trading, it all amounts in that we are attempting to change our current lot in life. That's the way that I view it, because as we've talked about before, this is like maybe a year or two old now, but this is average, right? Like this is what the average path looks like. And again, one of the things I knew super young is my mom, she didn't have a retirement built because that's just not the way her occupation was set up. And I picked that up super early. And I viscerally remember always worried about money. Even as a kid, I was worried about money because I could tell how big of a deal it was. When you grow up in that kind of environment, it's very, very apparent. And again, this is not some sob story. I imagine literally everybody listening to this has some flavor of that. So the reason why that's super important to understand is because then when we get into the conversation of what trading is, what we're trying to do, I want to highlight a really, really important starting point. So my starting point is of two buckets. One of them is necessity and hope. Unfortunately, both of these are really, 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 really bad starting points for doing something that's really difficult. So necessity, really both of these things, when you're looking at something hard enough and your intention is like, I've got to make this work, the issue that typically leads to is a whole slew of cognitive faults in the way that we're analyzing things. And this leads to my first bad habit. The first bad habit that I want to talk about is know thyself. When I started trading, I was in high school. I mean, my frontal cortex was still fucking developing. Like I was an adult. I consider that an adult. I know that might be a hot take, but I think once you're 16, 17, you're kind of there. So, but just because you're grown doesn't mean you're fully mentally developed, and you certainly don't have a lot of experience yet. I absolutely know I didn't. I did not know myself. If you'll recall from the reading yesterday, there was a couple key traits that we talked about that are super important. Something like humbleness. Others like self-awareness. These are difficult for people to do. I was listening to a couple people talking about whether or not they think being fat is a choice. And that, I think, is just a fascinating conversation. But in this context, like listening to those people talk about that, it shows that there's a whole lot of breakdown and a big gap in the way that people understand things around them. When I look at this habit, how did this manifest? The way that this manifested was primarily in not being methodical. Which I'll talk more about why that's so important. This gap in self-awareness, this gap in humbleness, it led to a couple really distinct things. One of them was it led to my largest drawdown. The way that it led to my largest percent drawdown, at that point, I'd been trading for a few years. I genuinely felt like I knew pretty well what I was doing. And it's because I was taking trading very seriously. This is when I was in college at that point. I had a binder with handwritten notes, hundreds of pages, diagrams, charts, everything. I was taking it so serious. I had study blocks partitioned out. So the discipline is there. All those kind of underlying things are absolutely there. But the key self-awareness elements were not there. So things like understanding my propensities. So in this largest drawdown scenario, what ended up happening was trading for a while, and it leads to the second bad habit, which is outcome focused. That drawdown occurred because I thought I knew what I was doing. I thought I knew what mattered. And I was so focused on the outcome of individual trades. I guess I should emphasize that. Individual trade. Because you need to be outcome focused as a trader, but individual trades, different story. I was so focused on the outcome of individual trades that it led to my hyper focus on the attempt to make a few $100s on a really high probability play and rut, that I did not analyze the path of those returns, what it could look like. And I'll show you what I mean. So it was something like this. If I go into SPY, I'm just using SPY because it's up, SPX, I should say. And let's say I was looking at like a 2-week trade, and let's go out wider. I don't remember exactly what it was, but I'm going to build what I best remember it as. That look right? Yeah, that looks about right. What was that? That's like a 5 delta short at the 62. Yeah, it's about right. So what I'm showing you is, again, a version of a trade that I think I put on. I really don't distinctly remember. Get rid of that. And I'm just going to go around. Something like this. So, oh, my bad. On the upside, we need to go another 100 points. Yeah, way better. All right. So here is very similar to what I put on. And if we take a look in SPX, this is for a 1 lot. Looking to make $400. Again, I don't remember the exact details. It's similar to this kind of trade-off. Looking to make $400 with $19,600 at risk. What I completely failed to appreciate when I first put this trade on is this. What is that? This is the space that shows an unrealized loss, even though the trade is at full profit within full profit zones. I did not respect that enough because it wasn't a 1 lot. I don't remember, again, the size of the trade, but it was enough where I was trying to make a decent amount of money on this. It was probably a little further out of the money. But what ended up happening was Like in this case, this is trying to make 2 grand, risking 98 grand. Super high probability that you're going to get it. But in the process of getting it, you'll notice that there's a point here where you might be losing 12 grand in the pursuit of 2 grand, even though it's still squarely within the profit zone. In that scenario, just have to wait. That's it. You just have to wait. But in my scenario, what ended up happening was this: it moved around and it started printing a really large outsized loss. Now, I knew the Iron Condor. I knew that it would do this. I knew that these existed. But what I did not fully appreciate was the dollar values that can show up here. So I knew full well that the trade could show a loss as it's well within this zone. What I did not respect was the dollar amounts that it could show me in this time frame. That is what led to me having the largest percent drawdown on the portfolio. I put this trade on, trying to make a few bucks. It prints an unrealized loss still being within the profit zone, and I saw the number on the account. And as soon as I saw that number on the account, I realized I did not fully appreciate what it might actually look like. And then my brain immediately went to, what if this becomes a full loss? What if that scenario happens? I'm already super uncomfortable with this number. I don't even want to think how I would feel, behave, act at this number. So I'm glad with how I handled this scenario. It wasn't a snap decision. I remember I was going to meet my buddy at the gym, a dude I played rugby with. And I met him at the gym, sat down, thought for a little bit, and then I just said, I need to close this trade. Got to close it. This is not looking like what I thought this might look like. I have not mentally prepared for the potential path of this trade. So if this ended up being a bigger loser, I was completely unequipped to actually manage the life cycle of that trade. So I just took it down. Now, for those familiar with the story, the ultimate irony is that it ended up landing like right in here. It wasn't even like towards the tails. It was like dead center almost. It was close enough. It was a really wide Iron Condor. So it ended up being a full profit at the expiration, but I was already out of the trade, so it didn't matter. So to recap these 2 habits really fast. The first one is know thyself. And in the context of a bad habit, this would be not know thyself. 2 is trade outcome focus. And before I show you the third, I want to talk a little bit more specifically about number 1 and how this number 1 bleeds over into literally everything we're talking about. So I have a series of traits. Some of them are good, some of them are bad. I imagine just about everybody has the same thing. One of those is an obsessive personality. Once I find something that I'm interested in, I cannot put it down. I become infatuated by it, and I just completely go all in on the thing of interest. That can be a good thing. It's how I've developed the eminence that I have had in trading, for example, or the gym, or shooting, or these other things that I enjoy doing. I know a lot about them because I care a lot and I spend a lot of time learning. Scuba diving, automotives, all that shit. The downside is that it can lead to follow-on decision-making that is suboptimal. For example, as I'm learning about options, I'm learning about all these different structures. As I'm learning the nuances of all these different structures, my brain is saying, how do I employ these verticals? How do I use this butterfly? Nothing wrong with wanting to understand how these things actually behave. That's okay. The problem is that I was looking to trade and make money using these different structures, thinking that there was some sort of magic in knowing these structures that would lead to me making money. It's completely wrong. It's completely wrong. Completely wrong. It's not how it works at all. As you all know, my approach now that I share with you all to try and help you not make these same mistakes is starting with a profit mechanism. From there, it's essentially scoping the profit mechanism, and in this is attaching signals. Then it's overlaying structures, then strategies. This is the process that I've refined it to over nearly 2 decades doing this. But in the beginning, I did not do that. In the beginning, I was somebody that was infatuated with something, spending all my time on it, really excited about what I was learning, and wanting to immediately apply and make money off of the different things that I have learned. Completely natural, but completely wrong. Doesn't make any sense at all in terms of how that would be viable. It makes total sense in terms of why I would do that. But again, it's one of those things that I genuinely hope you are able to not do, because there's very little to gain from that. Another trait that I have that we already hit earlier, I think it was Dark Mark, shout out to you, is risk aversion. That risk aversion is part of the reason why I didn't fully acknowledge what the dollar amounts could look like here. It's why I didn't fully acknowledge what the trade could ultimately lose, and I was so focused on the profit side. Risk aversion has been an underlying nagging thing that I've had to find different ways to navigate throughout my entire life. What I've learned after a lot of reflection is that this risk aversion stems from what I refer to as a scarcity mindset, growing up in a scarce environment. Now, this is psychologically programmed into you as human beings. Here's why. If we have a scale, and on this scale, you can make, let's just pretend that was flat, you can make the same amount on either or. You can either make 1 shekel or you can lose 1 shekel. The human condition has primed us that until we have met our baseline needs, we much more value this, and we absolutely disdain this. Why is that? It makes perfect psychological sense. If losing this 1 shekel is the difference between you being able to live your life as you want or not, we do not value these as the same thing. The prospects of winning one or losing one, they're not the same, because the severity attached to this one becomes greater. Here's the problem. Over time, as we move further and further along this continuum of needs, so let's say that this is needs, let's say that this is like general wants, and then let's say that this is high-end wants. As we move along this continuum, I should have been able to recalibrate my brain from this. Heavily struggled to do so for a long time. So what this led to is I would be looking at things that made complete sense in terms of the sizing protocols relative to the portfolio, completely logical. However, I mentally was uncomfortable with the dollar amount. So let's just say that if you have $1 million. If you have $1 million and you're risking $1,000, that $1,000 is so inconsequential to that $1 million. So inconsequential. Yet, for somebody like me growing up in a scarce environment, that $1,000 nominal value, regardless of what the total capital is, that $1,000, I view that $1,000 as the things that I could do with it. With that $1,000, I could have paid to fix my mom's car. I could have got the parts I needed. I could have done blah, 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 blah. So that leads to another really important behavioral gap that I had, which is an inability to mentally detach from the trading capital. And as I got better at that, this got way easier. Being able to size things as I wanted became easier. But it wasn't until I did that did this become easier. So I employed a ton of different little things in order to prime my brain to make it easier for me to successfully achieve mental detachment from my trading capital. One of the things I would do, even as a joke, for those that don't know, there's a lot of power in joking. And I would joke with myself that as I sent money into the trading account, I would do the South Park thing. I would just say, and it's gone. I would just literally make that stupid little joke to myself. But believe it or not, that stupid little joke has an element of subconscious priming to it. So everything from that little language that I would use was very purposefully put into place, along with a slew of other things to help me create that mental separation. I completely disallowed myself from looking at the money and thinking what I could spend it on. The money that's in the account, it can't be spent on anything because it's in the account. There's nothing to be done. It's in the account. So it's a list of all those kinds of things that led to me being able to successfully distance myself more from the trading capital. Ultimately, it allows me to make better decisions. If you can be dispassionate, completely cold and calculated towards the decision cycle, you can make way better decisions than if there's all this emotion wrapped into this dollar amount. So that's another massive behavioral gap that took me a long time to figure out. This is a good spot for me to plug something that I always try to plug because it's something that was really important in my life and maybe it applies to you. When I was in junior high school, I used to say to myself, I'm bad at math. I'm bad at it. I'm just bad at it. I wasn't grown up with that kind of brain, just not good at it. And one day I literally just stopped saying it. I just stopped saying the words. I stopped letting myself say it. I didn't start tricking myself into saying you're good at math, because that's a bold-faced lie. But I didn't need to continually tell myself I'm bad at math. So I just decided to stop. And genuinely, all of a sudden, I started getting better at math. Never became a math savant. I still don't consider myself great at math. That's an objective evaluation. But I absolutely know I'm more than capable to learn pretty much any math that I could possibly need to do the things that I do. It's also part of the reason why I spent so much time learning stats, because I did find that statistics made a ton of sense for my brain, and I'm quite good at stats. So the broader thing that I want to make sure you all are aware of and appreciate is this self-talk that you use, whether it's a joke, whether it's in passing, whether it's something you don't really believe, but you're just kind of playing around. You have to be super careful with it. because I'm really big into self-deprecating humor. I think it's hilarious. And I think that can be done successfully. But if you do something too much or too frequently, it does start to have negative carryover effects that absolutely will impact your subconscious processing and the rest of literally the way you apply yourself as a human. So that's kind of a broader general piece of information that if it's not something you fully appreciate or have thought much about, I fully encourage you to, because it made a massive difference in my life in more than one way by, again, just not lying to myself and saying, oh, you're great at math, but literally just not allowing myself to say I'm bad at it and just deciding, this is difficult, but I'll figure it out. I think it goes a long way. All right, let's talk about the third thing. The third this is probably the worst habit out of all of these, which realistically, all of these are pretty terrible, to be honest. But this is probably the most terrible, the terribility factor. I think horribility. My friend Joe, we were joking about something at one point, and he came up with the term horribility, which I really, really liked, horribility. But the biggest thing here by far is lack of process. Lack of process feeds through literally everything. Without having a defined process for doing different things, there's so much that is missed and so much that is done so inefficiently that it all could be employed completely differently. Tell me if this sounds familiar. I started learning about options. I spent maybe a couple weeks. I learned what they are. I learned the rudimentary settlement rules. I learned a couple structures. And then I started trading. And I first started trading by trying to buy things that I thought were going to go up. And I would do that for a few days, few weeks, maybe. Then I said, maybe I'm really good at trading things to the downside. So this was primarily done also through buying, but also some selling. Then after I tried going downside, I thought, why not be directionally neutral? Don't have to pick a direction, just be neutral. Tried that. And as I'm trying these different things, as I'm trying my upside buying strategy, I start with trying to use a MACD indicator. And then I say, well, I wonder if this will work equally as well with moving averages or better. Or as I'm trying to go to the downside, I'm thinking if I see RSI or the McKellen oscillator or Keltner bands or channels, Bollinger bands, like testing all these different indicators. As I'm doing all of those things, I'm tracking nothing. So I have absolutely nothing that I can objectively look at and say, yeah, that worked. No, that didn't work. This is how I was putting on these trades. All of a sudden, I'm getting a ton of absolutely abysmal confirmation bias because I'm seeing things like, oh, when I'm trading things with the MACD oscillator, I have a high win rate. Meanwhile, if I looked at the strategies for the MACD oscillator strategy, I might have just been selling puts instead of buying calls. Selling puts will have a higher win rate. So that's being completely fooled by inconsequential feedback mechanisms that I'm completely misunderstanding. If I had tracked things, this all goes away. All of it. Also, what goes away is this. What goes away is this. So the fix here was really, really simple. The fix here was to start a trading plan. After I started the trading plan, the next step here was to create a log. That's what I needed to do. By getting those two documents started, out of the way, operationalized early, it literally changed everything for me. Everything. And it's why I talk so much about using those kind of documents, which I know I haven't found a good way to really crack that nut with people. Because I know for a fact, when I say it, it's the kind of thing that people will say to themselves like, oh yeah, that's a good idea. I should do that. But also what I know is that the majority of people do not do it, even if they know they should. So I unfortunately haven't found a good way to navigate that as successfully as I would hope. But that is one of the items that's on my to-do list for you guys, because I do think there's a solution there. I just haven't figured it out yet. But you all know I'm super passionate about things like the trading plan and trading log, not because I just think they're cool to do, but it's literally because I have experienced the impact that they've made on my trading career, and it's beyond profound. It's literally revolutionary. So my hope is to try to encourage other people to do those as much as you can, because again, if you do those successfully, all of these other things start to go away. Missizing trades goes away. Letting winners exist for too short of a duration and allowing your losers to run for too long, that goes away. Having some sort of obsessive relationship with high win rate, that goes away. If you have a well-defined plan and log, all of these other things, it goes away. And it's because you're looking at your actual performance and you now just have to reconcile. And a lot of times it's spending time looking at shit that you don't want to look at because it's kind of uncomfortable. For example, if we go through something like Theta Gang, you're going to find tons of people who actually genuinely put in as much effort as they can. But in a lot of those instances, if we actually look at how they're performing against a broad index buy and hold in the S&P 500, the majority of them will underperform. And it's because of the way and the structure of how they're trading. That's a shitty piece of information to have to confront if you're not in the right headspace to confront it. It's pretty difficult. Hey, what's up, Lauren? Lauren says, I started logging my trades, but after I input the information, I'm like, what now? So it's a great question. So specifically for you, Lauren, in the skill development page on the Discord, there's a video on this exact thing. Let me find it for you. And while I'm looking at this for Lauren, I would love to hear any habits that you guys have that you're trying to work through. So Lauren, that's the first one. This is the second one. And then let me find one more for you. Case you don't know, I have an absolute ton of videos, but all right, so this is another one that will be relevant. The AAR process. Let me find that here. And this one is actually pretty recent. Here. So that one is about how to actually optimize an AAR process and to be more efficient. And then cool. So you have a handful of resources to start with there, but I'll walk you through some of the high level things that you can do. Let's approach this from the context of we don't have a stats background. And I purposely want to approach it this way because most people don't. So let's talk about it from there. So Lauren, help me out here. The first question I have for you is, what kind of strategy do you have your log built for? So what is it? What's the strategy that you're tracking? If it's multiple, that's okay. Just pick one and we'll use it as an example. And I'll literally give you a step-by-step approach that you can take on the kind of things that might be useful to look for. So the starting point is, and this is for everybody, if you have a trade log, the first thing that I like to do is I have multiple tabs in my trade log. So I have a C2C, which is military speak for command and control. The way that this tab works is it summarizes everything from the other tabs. Then I have other tabs. So now I have one that I call singles, which is just kind of like a general log that can handle most things. And then I have strategy specific logs. So I have things like the coverage triangle. I have things like ratio call diagonals, things like ratio put diagonals, earnings, structural, and so on. So the way that this works is all of these have the relevant information, and then I aggregate them up to this. All right, so Lauren says, always calls. Okay, so talk to me about the strategy. So in your case, we have a tab called long calls, or we'll just call it calls. The first thing that I need to define for this strategy is, what is the profit mechanism? So Lauren, what is the profit mechanism that you're attempting to capture with these long calls? Beautiful. Momentum and drift. First of all, shout out to you to being able to even produce that. Most people don't even know how to answer that. So genuinely, good job. So we got Momo and drift. So the next thing that I would think about is twofold. The first one, so we'll call this A, is a breakdown of how these behave. Momo scoping and drift scoping. In this scoping, I'm quantifying and qualifying. These profit mechanisms. So what does that look like? This is me finding information about momentum. We'll just zoom in on momentum specifically here. So I care about things like in A1, I want to know what defines momentum. 2, traits. 3, trends. 4, signals. And it's at this point when I'm postulating different signals that might help me identify momentum. So this will be things like RSI, support and resistance, volume nodes, moving averages. So going all the way back out to Lauren and the question of like what to do with this stuff. It's a great question. The way to start answering that is by being really zoomed out and essentially saying, how can I improve this? How can I improve my momentum-based long call strategy? What are things that I can do to make this better? Part of that will come from reviewing the results of what you've done. So if I take a look at a trade log and I plot the P&L, I'll grab something for you right now. Here. Oops. If I look at, oh, that's kind of annoying. Normally when I take a screenshot, it automatically pops up to make it easier. So if I'm looking at something like this, and I look at the sample of my performance, here, I'm just trying to eyeball. How does this thing tend to break down? How do I tend to perform? Now, this is all random assigned buckets. This isn't a good example of what actually to do, but this is a good representation of one view you can take that's very informative. So we can look and we can see that, okay, if normally I would start with a zero line, obviously, and I would bucket them in even buckets off of that zero line. But in this case, we can still see that on the winning side, there nonetheless is a concentration around specific bands. And on the losing side, it goes out pretty far compared to the winning side. All that stuff is relevant to me in terms of trying to figure out how to make that better. The process I'm referring to right now, again, is one that you likely will have heard me refer to before called cutting the tails. The idea of cutting the tails is to see if it logically improves your strategy. Sometimes it does, sometimes it doesn't. But it's one of the easier places to attack with respect to the deployment of a strategy. So that can be including things like, let's say, for example, that there are 3 instances in this bucket. Well, if there's only 3 instances in this bucket, the first thing I want to do is understand those instances. When are they happening and why? From there, I'm going to say, what kind of rule set might I be able to apply to attack this kind of thing, not just in the past, but going forward? And then I would implement that rule change. Once I implement that rule change, I would test my performance in sample and out of sample. By testing the performance, that can be simple as going through my other trades and seeing if they would have been stopped out applying that rule. And if it's the case that, let's say, for example, for everything else here, let's say from the winning side up, let's just say for everything else here, the max loss that these ever show is $2,800. But there's 3 instances that led to this. So if I implemented some sort of stop where I'm getting out before this $3,000 loss, I'm not going to impact the trades here because they're not hitting that. And that's a good example of cutting off a tail. So that's one way to use a log. That's just to give you some inspiration in addition to those videos. The most important way to use a log is to look at it and say to yourself, how can I make this strategy better? What information do I need? What information could I use to make better decisions with respect to my strategy? That's what you're trying to track in a trade log. That's a really good question. Alberto says, my bad habit is I'm going to wait for this to dip before buying just to see it keep going up and I miss a good opportunity entirely. That is a terrible habit, one that I also had. I refer to that as bargain buying. Easy to fix, really easy to fix. So if we take a look at something that's been going up, let's find something. How's Rocket Lab been doing? Great. Been going up. So if we wanted to get into Rocket Lab, let's say that we wanted to get into Rocket Lab here, and we said, okay, I'm going to wait for a pullback until it hits, once it hits the 22 handle, that's where I want to get in. And as Alberto points out, it's super common for it to literally never see that again. It's never been back to the 22 handle. But that's where we wanted to get it. So then it just leads to us sitting out. So the way that I approached that one personally was pretty simple. What I would say to myself is, I think it's high here, but I think it's going to keep going up. So I'm going to buy a portion of the position that I'm comfortable, where if it got down to whatever I would consider to be some sort of bargain, I would want to get out at that point until it stabilizes. So here's the way that I think about it. If I get in here, let's say as it was breaking out at 52, but let's say that I really wanted to get in at 45 or whatever. One, the 45 is completely random, right? It's just picking something. It should be relevant to whatever you're looking at. But more importantly than that, what I would say to myself is, I'll get in here, and then if it goes back down to 45, I will add more. And then if it keeps going down, I will get out until it stabilizes, and then I'll get back in. So the thing with bargain buying is that it works terribly in trading. It works really, really poorly. And it's a good way to sit on the sidelines more often than not. And it also honestly shows a pretty strong fundamental misunderstanding of how markets behave, how things like momentum work. And the reason is it's because it's the antithesis of what we're taught, right? Like, you're taught to get things on sale. You're taught to prioritize being thrifty, to get stuff cheaper than whatever the posted ticket price is and shit like that. But the reality is, in trading, you have to reconfigure your mind entirely, which is really, really, really difficult. But nonetheless, absolutely one that's really useful. Alberto says, I'm trying to rewire buy low, sell high to buy high, sell higher. And it's the other thing to remind yourself is that it really is made relevant to the strategy. So what that means is buy high, sell higher works for momentum stuff. It does not work that well for value stuff. If you're trading a value-based strategy, then it doesn't work as well, which goes back to the importance of tracking and logging. Because if you have a log built and you can quantify to yourself and prove to yourself that when you're buying things that you might think are a little high, but you're making money on them consistently, that will evaporate. That will go away with a well-crafted trade log. Because once you have that proof, then that part of your brain will completely relax. Because otherwise what's happening is your body is just leaning on what it tends to know, probably devoid of the information it would need otherwise to help move through that roadblock, which is super, super common. All right, one more. Reese says, I've stopped writing short calls as much. They were a drag on returns, but felt like a rebate when buying stock. That is a super common one. I would take that one step further, and I would say traders notoriously get really myopic when it comes specifically to premium strategies. And they really become way too focused on trying to, get as much premium as they can versus focusing on what ultimately matters, which is how to make as much money as you can. Fun fact, I have a video coming out in a few weeks that talks about this exact thing because it's a weakness in the wheel as it's commonly used. So in that video, I go through a couple ways that you can make that a little bit better. But that's a very, very common habit that traders have that ultimately just costs them money long term, which kind of sucks. But it is what it is. Super fun. If you guys need anything, you know where to find me. Be an outlier. See y'all later.